All right, welcome back. We just left off in the last part. We left off at depreciation and amortization, 1031 exchange. We left off at cash out refinance and stepped up basis, which essentially means that if your parents die and their property is still in their name, the property is stepped up to the current cost basis as if the gain never happened, so it's not going to be taxed. So continued real estate and business. Certain improvements to the property can be written off. So in other words, that is a business expense within your real estate business. If you improve the property, that can be written off. So instead of profiting, you can just take something and you can improve one of your houses. That's a way to avoid taxes. As we said in the last part, selling a home after you live there for 2 years is not taxable for single people for $250K, and for joint $500K. Profit is tax-free. So some more real estate and business, disputing the value of your property to lower property taxes. So essentially what you can do is you can lower your property taxes by getting an appraiser to come out and value your property at less. So one thing about property taxes is that if your value of your property goes down, unless you get it reappraised and unless you actually appeal the property taxes that are levied, you will be paying just as much in property taxes. Your taxes won't go down unless you actually appeal it. So that's one good thing to know. Hiring certain people and enterprising zones. So that's basically diversity, being more diverse. You can get a tax break and enterprising zones. So certain places, certain neighborhoods, if you actually go and develop there, if the government incentivizes you, you can basically write off or deduct a certain amount of your income just by building in those areas, just by hiring those people. So continuing with real estate and business, selling your business for public stock in a company. So if you sell your business and you get public stock, or if you sell stock in your company, those are treated as capital gains. So that's what we call portfolio income. So that's going to be taxed at those 0, 15, and 20% tax rates. So as we can see, if you're a business owner, you're an entrepreneur, you are an investor, you're getting taxed less for the income that you actually bring in. So you actually get to keep more of your income. So sell private stock in your company. We just went over that. It's going to be capital gains. And corporate structures. So there's a lot of ways that you can set up your corporation so that you can basically earn more. Okay, so this one was really interesting. This top bullet, basically what you can do is you can set up multiple corporations that all have less earnings than they would have by themselves. So it's this whole big web of corporations where, let's say that I have an accountant, but instead of paying them within my business so that their earnings are counted on my business, I set up another business and I pay them within that business, or I set up HR as another business entirely. All of those incomes, basically, since one business is paying out to these other businesses, let's say I made $500,000 in my main business and I pay out $200,000 into my HR and accounting businesses. Well, now I'm paying taxes on a lot less revenues because each business individually makes a lot less. So offshoring, that's basically setting up your business in different places. So you can avoid taxes by setting up your business in different places, and you can avoid taxes by setting up your business in different municipalities, different cities that have different tax laws that basically advantage what you're doing. So you'll have to talk to a CPA with all this stuff, but if you set up your business to operate in different cities and states, for example, some states have no sales tax, some states have no state tax, for example, you can basically save yourself on taxes by putting certain things and certain people in certain states. So investments, that's what this channel is all about, is investments. So investing credits, basically what the government is doing is they are incentivizing you to invest in certain things. So oil, low income housing, diversity. We've already talked about all those things. Life insurance proceeds. Essentially what that is life insurance proceeds. If you name a beneficiary, the beneficiary is not taxed on those proceeds. So if you have a $400,000 life insurance policy, the beneficiary will get that full life insurance policy because you've already paid taxes on that money that you put into the policy. So state and local bonds, those are loans to the state and local governments. Those are tax-free in certain circumstances. I would have to check on that myself, but a lot of those investment vehicles can be tax-free. trading inside a self-directed Roth IRA. So Roth IRAs, if you trade within them, the taxes on the gains are not going to be they're not going to be taxed. Investing in oil drilling. So these are the things that you can deduct in oil drilling. Equipment to drill, 30% of the costs, which of course, as we talked about earlier, if you're deducting off of that your oil operation, you can take that and you can put it into another business. You can say that this is my overall business empire, and over here we lost this amount, so we're going to deduct it, in my real estate empire or whatever. So it just gets you some more tax benefits to be invested in those oil drilling operations. So it's got to be the drilling operations and the discovery operations. It's not just like going and buying some Exxon Mobil stock. And I'll let you guys look at that. I'll let you guys read that. But basically, you can deduct 15% of the oil wells' gross income per year. So it's basically going to be more profitable. They're incentivizing you to go in and invest in those oil drilling operations. They're subsidizing it. Okay, so in here, these are pretty self-explanatory. Certain mining operations, renewable energy investments, investing in agriculture, so like costs of farms, things like that. And gold and silver, this one was interesting. They're taxed at higher long-term capital gains rates, and that is to discourage their purchase. So that's a whole nother video right there. The US government trying not to get people to purchase gold, but anyways. And like I said before, all these tax benefits, you can basically shift them around into all of your businesses. Investments continued. So if you are a stock trader, you can basically write off your trading commissions because it's your trade. So basically the US rules, they're listed right there. I'm not going to sit here and read them to you guys. Basically what they mean is you have to actually be doing this as a job. You have to be trading with this a large amount, and you have to actually be clearing a pretty good profit, living off of that profit. So if they can tell that you're actually a trader for a living, you can actually write off those commissions as business expenses. Okay, last slide, and then we are going to close out the video. And the last thing is charity. So charitable remainder trust and charitable lead trust. So basically the difference between those, both of them reduce your taxable income, but one, the charitable remainder trust, the income goes to you while you're alive or during the term of the trust or the agreement, and the assets go to the trust after you die. So charitable lead trust, the income goes to the trust for the term of the trust or until you die, and then the assets go to the heirs thereafter. Last thing is you can take an income tax deduction for the donation when you set up the trust. So anyways, these are some eye-opening things. They really changed my outlook on the whole $750 story that has been put out. So if you guys did enjoy this video, it took a long time for me to put this together, and it's obviously not the most interesting thing to watch, so congratulations to you. If you actually had the hunger for knowledge, you actually wanted to know, is this story valid? Is this story worth actually listening to? And I'll tell you right now, I can't speak for what specifically Donald Trump did, but what I will say is there are a lot of ways to get around paying taxes. So I would not personally be surprised if everything he did was legal. Whether or not you think that it was moral, that's your choice. Whether or not you want to take advantage of these things yourself, once again, that's your choice. But anyways, if you want to join that Facebook group, we've got a community of millionaires. We're almost to 100 members, and I will see you guys in the next video.